Okay. Okay, so the first thing, it might not have been updated on all versions of the program. We unfortunately, the third paper, the present of the third paper, Jason had to bow out due to, I think he had planned to do a archival trip just beforehand that hopefully would have given him enough material to present, but he said like, well, that got kind of like waylaid through some recent kind of ideas. Plus the Australian archive was not as resourceful as he had hoped. So therefore he had decided that like he doesn't have enough that he thinks is worthwhile to present. So that means we currently only have 2 papers in this session, which also means that like I'll give you a little bit more leeway in terms of like whenever you want to finish, essentially. Yeah, and so the first paper is a joint paper by actually a number of authors. So we will have Simon and Grant presenting, and then there is Frank, and then of course, congratulations again to David Merritt, well, he's still there, for being awarded the Shen Award, and obviously thank you very much for being here and for all you do for the profession. Okay, so then I don't think I have to introduce Simon and the rest, so I'll just let you basically go on and present. Thanks.
Great, thanks Florian. Can everyone hear me? Yep, okay, great. So yeah, various authors, as you said, it's interesting the way publishing practices changed. The first 10 or 20 years of my academic life, I rarely published with one other person, and now the numbers on almost every paper seem to be about 3 or 4. So a group of us with, I think, very complementary skills are presenting this paper. It's our second paper together. We've worked on one which has recently been accepted on the Australian equity market. So now we've got one on the bond market. Why not? Every economic historian and economist is interested in how is economic development financed, how is it funded? And so, you know, interest in capital markets is always there. And one sort of historical fact about Australia that everyone knows, you know, every schoolboy knows, or school child or whatever, is that 19th century economic development was, in Australia, was heavily reliant upon foreign sources of capital. We know large amounts of foreign investment, both portfolio and FDI, came in from Britain. And David and I, in a separate project, have been working on the history of multinationals. We never realized there were so many in 19th century Australia. Now, in the 20th century, there is a pivot from foreign towards domestic capital, capital market in Australia. Now, that's not to say that foreign capital doesn't remain important, but there's a significant growth of a domestic capital market. And that's what our equities paper is about. And this is what this paper is about primarily. So it's about the role of the domestic bond market or debenture market, and you'll see we use the terms interchangeably in the economic expansion and diversification of Australia in the 20th century. And there are 2 main themes or topics that are interest to us in this paper, and it is in a very early stage of the paper, so we may end up jettisoning one of these, or maybe end up being told by referees to jettison one of these. But as they stand at the moment, this presentation, the 2 things. First of all, is the data on the long-term study of a national debt market, including the trends in that market, the drivers, the performance, which sectors and companies mostly benefited from the bond market. But there's a second question as well, and one that is of been a lot of interest to writers on finance, financial history in recent years. What makes for a successful issuance? In other words, the question is, how does a early stage capital market attract investors? And there's a thing called the law of finance hypothesis, which basically has been argued that you need good legal foundations for a successful capital market, protection of investors, and, you know, other bits and informational things like good intermediate advisors, credit ratings, independent sources of information, etc. And so that's the law of finance hypothesis. But finance historians have been establishing increasingly that, you know, you ask the historical question, how come there have been productive and active and growing capital markets in economies in periods before the growth of this type of legal protection. Quite a bit of work has been done on the USA and the UK in particular. People like Les Hanna, who of course is very well known to economic historians, have asked this type of question, but also people like John Turner, who operate mostly in the area of financial history and finance. So we're interested in that question: what makes for a successful issuance in the experience of the early Australian capital market? And the question of successful issuance, and Grant may well go into this in more detail as the dependent variables and their regressions, but the two things that we tend to focus on are superior pricing. In other words, companies that are able to sell their bonds as close as possible to the so-called risk-free government bond rate, and period to maturity. So obviously, if you can pay your debt off over a longer period, then that's a good outcome as well. So there is various literature on this topic, and as ever with a brief conference presentation, flip through this fairly quickly. So there has been a few long-term studies of national corporate debt markets. As I mentioned earlier, some work on the UK by authors like Coyle and Turner, work on Brazil by Aldo Masaccio, and also some work on the USA as well. And that work has tended to find that bond markets in these countries often reached a peak in the early 20th century, particularly in those countries where railway construction was funded through debentures. The UK and the US are classic examples of that. And then there's a long-term decline in the 20th century, with fluctuations in that decline. And they've looked at some of the reasons for those fluctuations and just decline, and just, aggregated a few of those there: the role of inflation, trade cycles, fiscal policies, and war are some of the reasons. So I mentioned the law of finance hypothesis. So this is the other part of the paper, the work of people classically like Laporta, that argue that successful capital markets need a strong regulatory informational foundation. And this is where historical work, including those examples that are under Aitchison, Campbell and Turner, and Cheffin, Banks and Wells, have looked at capital markets that have been successful before the onset of modern legal protection. And they've found explanations, again, just very much a brief summary of their work, in the operation of informal markets, the value of stable dividends, and the extent of self-regulation by companies. Australia has had limited research on these questions, and you'll notice some well-known names at the bottom there. David's 1997 survey of the Australian capital market is really a foundational piece for the work that we're doing now. The Big End of Town, which Lionel is reading yet again, I gather, when I logged in. There's a chapter there on corporate finance, and then David and I wrote a chapter on new equity issues for Business History Review about 10 or 12 years ago, and then the paper on the equity market, which the four of us have written before coming on to the bond study. So here's a bit of summary comparison between different countries' stock of bonds as a percentage of GDP. And this is primarily taken from the work of Aldo Masaccio on Brazil, but he was comparing Brazil with other countries and addressing this question of, is there a relationship between legal systems and the size of the bond market? And the answer seems to be no. And what we know for Australia is that you can see it's a small but growing bond market. And the other observation, the fairly obvious few outliers in that table, is that we've got to sort of, look again at some of this data, is that for some countries, this includes a lot of overseas companies. So we're focusing on bond issues for companies based in Australia. So, that UK, USA data may be not necessarily consistent with what we've got for some of the other countries. So the data that we're using for this study, 4,900 or more debenture or bond issues by 436 companies between 1915 and 1983, both corporations, private firms, and publicly traded enterprises. It excludes banks, as does most of the finance literature. We'll come back to why you'd like to do that. Data collected is from a data set on debenture issues by the Reserve Bank of Australia. And then for some of our explanatory variables, they're company financial variables taken from the Australian Insurance and Banking Record, from Jobson's, and from the AGSM's annual report record after 1951. So those are company financial variables, and also macroeconomic variables taken from Buckley, Dixon and Lloyd from the Cambridge in 2015, and from a paper by Matthews in 2019 on the Australian equities market. So some basic information of the size of the bond issues market in Australia as a percentage of GDP. So you can see some fairly significant trends there, particularly the rising importance relative to the size of the economy in the 1920s, and then again in the 1950s. And a few observations we should make to put this in context is that retained earnings have always been important, and also that the equity market is significantly larger than the debentures market. But, you know, this is what we're studying at this stage. And you'll see this interesting dot point right at the bottom, which is not part of this paper, but may well become part of a later paper. And that is the re-emergence, the rapid expansion of the bond market after the 1980s. But that's not the focus of this particular paper. Then we've also got the data expressed in real terms, bond issues in real terms. So you can really see the significant trends there. There's some cyclical fluctuations in the 20s, 30s, 40s. As I said, rising in the 20s, falling in the 30s and 40s, and then big real term rises in the 1950s and 60s, and decline thereafter, at least until 1981. And so the question of, you know, how significant were bonds in financing the breadth of the Australian economy? This is, you know, quite valuable data, I think. You can see that bonds were used in a wide variety of industries. It does vary a bit over time, as our dot points clarify on the right-hand side, but you can see running down those, whether you're looking at number of issues or the value of those issues, that, you know, it's covering a wide range of industries. So, you know, that does feed into an understanding of the role of the bond market in the, you know, diversification of the Australian economy in the 20th century. So that's my part of the presentation, very much about understanding the context in which we're doing this work, the wider literature, what we're trying to achieve, some of those initial results in terms of the size of the bond market. The rest of the paper Grant will be presenting, which is very much about asking those questions of what makes for a successful issue and the regressions that underlie those questions. So I'll pass on to Grant.
Thanks, Simon. In fact, if we could just focus back on the previous table just for a second, we did make the point that we had excluded banks from this data. Banks were indeed important issuers of debentures to finance their loan books alongside deposits throughout the throughout the period we're studying. You will notice, though, the Code 40 Financials 2,230 issuances of debentures by financials. They are non-bank financial institutions, and we decided, and so these are the high purchase and consumer credit companies that really grew very rapidly in the early 1950s through to the 1960s, as has been noted by a number of authors. Thankfully, one of them's on the call today, Pierre. And so we decided to include those organisations in this data set because while they're very similar to banks, indeed, you know, non-bank financing entities, we thought they were very important in explaining the rapid growth and size of the debenture market throughout the 50s and the 1960s, both in terms of the greater acceptance of lending to businesses and also changes in lending duration or maturity for loans that takes place during the 50s and the 60s. So Just a couple of slides then on what we've done from an empirical perspective. And a lot of the results we're showing you today are very preliminary. We would certainly value additional insights that you might have, or if we stimulate your minds with regards to additional areas of work, be very happy to take those comments on board offline. The first is to bond spreads. So what we've done is that the blue line here shows nominal bond spreads, or nominal bond rates, I should say, for an average of all bonds that are issued each year from 1915 through to 1983. So this is the nominal rate at which the company strikes the debenture and the rate of interest it promises to pay investors over the duration of the bond. And you can see this, the nominal rates there range from about 4% to 8% up to the 1960s, and then increased quite dramatically, quite obviously, as inflation impacts the nominal rates of those bonds from the 1960s onwards, not too dissimilar to trends we've seen in other markets such as the UK and the United States. The orange line is the average bond spread. So this is the corporate bond spread. That is the difference between the nominal blue line that you see here and the risk-free rate for the 4,900 bonds. What we did is we individually matched each of those bonds to the same government bond that was issued on the same year, and with as close as possible maturity matched to that bond as well. So in other words, the corporate bond spread here represents the risk-free rate for a similar bond that was issued at the same time and approximately the same duration as the corporate bond was issued. And you can see here that the bond spread, or the corporate bond spread, that is the risk rate, trends around 2% up to the mid-1950s, in fact, and then from the 1960s onwards increases. We have broken this down. We don't show this here, unfortunately, given time, but we have broken down the bond spreads by some key characteristics of types of companies that issued, and in particular, characteristics around regulated businesses, that is publicly traded enterprises, straight corporates, and non-bank financial institutions. We actually find very similar corporate bond spreads up to the 1960s, and then the regulated industries continue to borrow at about 2 to 3%. However, the non-bank financial institutions and the corporates end up paying a greater spread over the risk-free rate than was previously the case. There's a whole range of reasons why that's the case, but just thought I'd mention that. The second data, or the second time series data, is around bond tenor, as they say in the industry, or term to maturity, as the term that tends to be used in the literature. So this is the term between, that is the number of years between the year at which the bond was issued and the stated maturity date for the bond, as per typically a trust deed or per the legal documents that was signed between the issuer and the investors. We presented the term to maturity two ways here, equally weighted, that is treating each issuance size the same, and value weighted. By value we mean the par value of the bond, that is larger bonds obviously having therefore a greater weight in the average than a smaller bond. And again, what we find is that prior to the Second World War, there's some variability in tenor, but on average, issuers tended to be able to issue bonds for longer maturity, and households and individuals, who were predominantly the investors in these bonds at that time, were willing to lend to or purchase debentures for longer periods. When we move into the post-Second World War period, we find bond tenor declining to somewhere below 10 years, and indeed from the 1970s a shorter duration again. We think that's got something to do with the nature of the issuers of debentures in the 1950s and 60s, number one, but also the refinancing market. So the size of the bond market as it grows throughout the 1950s and 60s enables firms to be able to refinance bonds much more readily, and perhaps having more confidence to be able to go to market with a shorter duration bond to know they can get refinanced, whereas previously, given the relatively thinness of the bond market. It's almost like any fund manager today. If you can grab the money, grab it today and grab it for as long as you can. So it was a very similar type of feeling we note from public pronouncements around bond issuances in the 1920s and 30s. With those two time series in mind, our initial quantitative work has been around trying to understand whether or not there are particular firm characteristics that, as Simon enunciated at the start of the presentation, explain the success of the debenture issue. We're measuring success loosely termed in two ways. One is the borrowing costs that the corporate has to endure to borrow for a period of time, and secondly, the term to maturity, or the time at which it can issue the bond. And we're not making any particular value judgments about term being good or bad. In fact, in capital structure and corporate financial policy literature, there's a lot of arguments that, in fact, short-term borrowing might be just as popular for large firms as long-term borrowing. But certainly one would expect that bonds with higher spreads cost more and have higher borrowing costs than bonds with lower spreads. Our regressions are on about 2,500 observations by which we could match or collect, which was a hand-collected data set from 1951, prior to 1951, or match into the AGSM data set, which came to us almost on a floppy disk from Phil Brown at WWII. So we managed to match about 2,200 firms to their financial balance sheet characteristics. And we used a number of additional indicators, such as regulated entities, publicly traded enterprises. Think about these as being gas, utility companies, gas companies, and so forth, telecommunications companies, non-bank financial institutions being the other key characteristic. Whether or not a firm has been regularly going to the market, we felt that there's some literature around salience and regular information flows that suggests that the asymmetric information, or the gap between a lender and a borrower, may be decreased. The information gap may be decreased if a debenture issuer is more regularly in the market. We have a number of definitions to look at repeat, but just we'll call it repeat. And thirdly, whether or not the firm was a corporate leader. I hasten to put a caveat around this, that really the corporate leader in the days of the big end of town was only measured on total assets. So it's a kind of a loose measure for what was a corporate leader in the Australian economy through the 20th century. But nevertheless, we try that out and see whether or not a larger firms with, again, more salience and perhaps having more information available on them makes any difference to borrowing costs or term to maturity. We have a couple of macroeconomic and regulatory setting factors that have deemed to be important in previous time series work on corporate bond markets, stock market conditions, going to the relative price of equity versus debt raising in any as a decision a firm makes. War and other periods of, but certainly war in this instance. The level of government debt, there's various reasons why a government debt market may crowd out private sector borrowing. There are also arguments that a more stronger government debt market increases the number of investors in the market, and in fact can have a market creating impact. There's not really any clear literature one way or the other on this in terms of empirical findings, but we look at that. And then some pretty standard capital structure, corporate financial policy variables that you would see in any typical finance paper: book leverage, profitability, tangibility of assets, size, and those sorts of things. Instead of showing you a whole bunch of numbers, what we thought we'd do is just sort of show you, which things are related to lower borrowing costs and which things are related to higher borrowing costs at this stage. We're very, very happy to share the paper once before Simon and I decide to finish writing it. But in essence, we find some, we think, pretty interesting and compelling results that suggest that the debenture market worked reasonably well, despite there being a very loose level of information being required to investors throughout this period. Disclosure rules changed, accounting rules changed over the period we're looking at, and we'll certainly look at that in a little bit more depth. But we found that lower bond spreads or cheaper borrowing costs were related to many of the firm characteristics we identified. Regulated firms were able to borrow at lower rates. Non-bank financial institutions, surprisingly, at least for me, were able to borrow at lower rates. Certainly repeat issuers and corporate leaders, and BHP as an entity by itself was able to borrow at lower rates compared to the whole population of, or the largest sample of corporate borrowers. In terms of macro settings, the government seems to have been having a market creating role here. That is, the more government bonds were being issued as a percentage of GDP. And remember, as Simon again mentioned, this was really a period when governments, state and federal, started to borrow more regularly on the domestic market rather than offshore. That is positively, associated with lower bonds. So the more government bonds available in the market, the lower bond spreads, and this is a corporate bond spread, of course, and larger firms quite normally can borrow at lower rates. A few things associated with higher borrowing costs, war, buoyant stock market, that is, equity was cheaper or easier to raise perhaps, and book leverage. One thing you'll notice here that we haven't talked about at all is tax. Tax shield for borrowers is very important. We would love any comments around tax and changes in tax policy in Australia through the 20th century, where frankly struggling to find really any demonstrable changes in interest deductibility over the period we're looking at, particularly from 1936. Where it seems to be, at least up to the 1980s, Australia ran a pretty straightforward classical tax system. So, but if someone does have alternative information or has somewhere where they can point us in the direction, we would love to know. And then just finally, some regressions we looked at around what's the association with borrowing longer, that is longer term to maturity, or borrowing shorter. To be frank with you, there's not really, a great understanding in the literature today about whether, what sort of firms borrow longer or shorter, particularly if you look at more contemporary literature, because large firms tend to use corporate debt markets much more judiciously and indeed borrow short and long, depending upon the nature of their assets and cash flows. But generally, what people would argue is that, regulated or well-known businesses tend to have ability to borrow longer. We certainly find that. More profitable firms can borrow longer. The investors in these bonds feel more comfortable if there's a good level of profitability to be able to lend to or subscribe to a debenture that has long duration. And then shorter duration connected to particular types of firms, most notably non-bank financial institutions, which borrowed short really because their loan books were short. And I think they were really one of the most important instigators in really developing a different nature of a bond market or debenture market in Australia in the 50s and 60s. Finally, size, which again, there's not really any set relationship between size and maturity. One of the things we haven't talked about in these slides, we do talk about a little bit in the extended work, is who invests in debentures. There's been some, on Please Monikers on the course, you've been really wonderful work on the rise of institutional investors in Australia throughout the 20th century and the importance of life insurance companies as institutional investors. They were, that is, life insurance companies, and the diversification of their asset pools and the, I'll use the word sophistication advisedly, the increasing sophistication as being important lenders to firms, I think is very important in the 50s and 60s. Households remain about 40% of the investors in these debentures over the period, but the rise of the institutional investor is one thing that we talk a little bit about in the extended paper. And it certainly goes, I think, to the increasing sophistication of debenture issuers who understand what investors need in terms of information in order to make their bond a successful raising.
Brent,
So,
could you slowly wrap up So maybe that
We
for another 10 minutes with questions.
We will. So to conclusions, Florian. So I'll just briefly mention some conclusions. I'll let Simon have the final word. You know, I'll talk briefly about, I guess, just in summary about the empirical results, and then Simon can sort of put this into context. You know, the empirical work's very early. We are very conscious. You don't just want to grab a whole lot of data and throw a whole lot of models at it. We should be very mindful of the context in which these markets are changing over time. But you know, we feel that the data set that we've created to date allows us to look at some pretty interesting issues with regards, or questions with regards to debenture issues, particularly about the relationship between firm characteristics, macroeconomic factors, and some of the normal firm financial variables you would expect to be important in issuances. I'll let Simon, you know, complete the conclusions. It's really about how do we put this work then into the wider context of understanding bond markets and finance markets in the 20th century.
Sorry, Grant, did you want me to say a bit more?
Just finally, so you know where you see you know, as you talked about, where you see some of this work linking into international research.
Yeah, no, sure, absolutely. So it's really how we see it fitting in is that there is, well, there are several issues here. One is that it very much supports this contrast of the law of finance literature. Clearly, there is no relationship, but also I think we don't have until now anything that really looks closely for the bond market at these issues of why some issues are more successful than others. In other words, the lower cost and longer tenure issues. So we've got those results. As you can see in that final dot point, some of them are clear, some of them are a bit more mixed. And I did just put at the end there, David and Laura and I wrote a paper a few years ago about whether size, amongst other variables, was a measure of a firm's longevity, and concluded it wasn't, somewhat to our surprise. And I think here again, size is not clearly or necessarily a benefit. As you can see from the results and the regressions. And as Grant's pointed out, the corporate leaders, we took that from the big end of town. Part of the measure of a corporate leader was that it kept on appearing in our top group over the 20th century, but it's not a perfect measure. So look, I mean, we feel what we've got here is a contribution to studies of national bond markets and their role in the economic developments of a nation. There's not much of that out there, particularly that goes over a longer period. And I think also we've got this issue of trying to more closely understand how firms and investors read signals about, you know, what are the characteristics of a successful bond issue. So I think, you know, there are other issues. We can probably leave it there. There's a few appendices. We probably haven't got time to mention those. That gives you some idea that, you know, the equity market is a lot bigger than the bond market, but, you know, it's still worth studying. And the only other slide is our bibliography. So I think that's about it.
Bob, thanks. The presenters, yes, Claire's reporting. Yeah, any questions? And I think we just continue what we did earlier. That's like, if anybody, this group is sizable enough that there's not an issue. If anyone has questions, just start talking, basically. Can I ask, how does this work with the kind of capacity to issue bonds? Kind of like who are like, what kind of capacity, like what do you need in terms of like financial infrastructure to actually have substantial issuance of bonds, and kind of like how does that develop in Australia?
That's a good question, because that infrastructure changes a lot over time. You know, I guess the beginning of the infrastructure is really something that David and others have written about in the late 19th century. That is the first investment in debentures to finance mining and railways. And so some of that, and indeed building societies and banks. So there's some overflow from that period, good and bad, into the 1920s. Good in the sense that people know what a debenture is, whereas for equity, evaluating an equity issuance in the 1920s was something a little bit newer, particularly as new industries looked to raise finance from external investors. Bad because they've had pretty bad experiences through different periods, and indeed, if you look at the 1890s, not a particularly good experience in investing in debentures. So, in the early part of the 20th century, the infrastructure was really around brokers and security houses, not too dissimilar to new equity issuances would take place. The JB Wares of the world and many others would broker or distribute a debenture. For the very well-known companies, they would often be able to issue themselves. Many of the smaller companies would be issuing debentures to their shareholders, sometimes their preference shareholders or just general shareholders. So there was some overlap between investing in equity and bonds. That changes through the 1950s and the 60s, where there becomes, a bit more of a, one more thing. What we know too is we've mapped in the number of debentures offered each year versus those that are listed on the Melbourne or Sydney Stock Exchange. And only about a quarter of these debentures are listed and are offered an official price. So it's kind of an over-the-counter market and a private price placement market. And that continues on throughout the 50s and the 60s as well. I think the rise of institutional investors, as I mentioned previously, becomes very important because standardised documentation, standardised set of information, the lead roles of A&P and other life insurance companies really means that a firm then goes to its known financiers from bonds and then is able to work with a brokering house to extend out to their group of clients.
I think the whole, the whole question of the evolving infrastructure of capital markets is really interesting. And as Grant said, there's so much informality and lack of, in private sales of bonds. And, it's all evolved from the late 19th century when a lot of Australian companies, including the great pastoral stock and station companies, a lot of their debentures were sold in Britain, in Scotland by solicitors and through personal contact. And yet, in many ways, that's a rich information environment for people to make decisions like that. And that, that gradually evolves in the 20th century, as Grant says, a lot of unlisted sales as well. So it's really interesting to see the way that apparently primitive infrastructure in capital markets could work and survive for quite a long time as well.
Do we have time for one maybe quick question, but otherwise, nope. Okay, then we might go on to the second presentation. We have Claire Wright, Macquarie University, again for paper with our co-author Benjamin Wilkie, colleague, and well, I'll let Claire take over.
Hello, can you hear me? Can you see my screen?
Yep.
Yep. Okay, wonderful. So look, good afternoon, everyone. Thanks very much for being here, and also thanks to Simon and Grant for a really fascinating paper. It's probably not all that surprising that Simon and I are in the same session, but potentially more exciting is the fact that we had very little to do with each other's papers on this occasion. So I always learn a lot. So look, it feels like a lifetime ago, but I think last year I discussed some of the characteristics of Australia's corporate elite. I focused particularly on profession and class, and that paper is happily now accepted and will be published in the coming year. I also have another paper similar to this on gender. And so I like to think of these three papers as a bit of a suite, telling different aspects of a similar story. Today, I'll take a broad view of the characteristics of the corporate elite, and including not just the professional work that they performed or their gender, but demographics, education, experience, geography, social connections, and so on. And this is, of course, part of my my broader postdoc project at Macquarie into Australia's interlocking directorates since 1910, and I've co-authored this paper with the research assistant on the project, Dr. Ben Wilkie, who unfortunately cannot be here today. So the composition of the corporate elite has been tackled from several different disciplines. Research in management and corporate governance has examined board members of top corporation to understand appointment processes, compliance with diversity objectives, the impact of composition on governance and profitability, that sort of thing. A diverse board is seen as a desirable thing, not only for equality, but also to improve monitoring, innovation, decision-making, and so on. Sociologists also have a long-standing interest in elites, and corporate elites as kind of like a big part of that. Scholars have examined sort of the social, class, geography, and political composition of elites, and others have focused on the impact, so their role in gatekeeping, inequality, political movements, and so on. Business historians internationally have brought together the insights of sociologists and the business disciplines, examining the development and impact of corporate communities over time. Some, including myself, have used a social network approach, so visualising ties between members based on directorships. The composition of the elite has been examined through crosstopography, so collective life histories, and they look at career trajectory, education, family connections, friendships, and so on. And others examine the structural or business implications of the elite, including the development of trust, exercise of group power, diffusion of innovations, development of collusion or cooperation, depending on who you ask. But in Australia, there is actually very little research on the composition of the corporate elite over time. Business scholars don't really like history, and historians don't really like business. Those in political economy have examined the concentration of power and wealth with this sort of top echelon of the corporate sector, but they focus on the important task of identifying the elite and their power rather than understanding its composition. There are numerous popular books, I'm sure we've all read one or more of them, about individual business leaders and large firms, but these fail to incorporate insights about how representative that person is to the broader cohort or their relationship with the broader Australian population. So in light of all this, the main contribution we make is to combine essentially the insights of the business disciplines and the sociology disciplines with an historian's methodology to understand the Australian elite in its context. So in terms of methods, so we examined the composition of Australia's corporate elite between 1910 and 2018. We've got eight benchmarks. Who or what is an elite, I hear you ask? That's a very good question. Elite essentially just means people for whom life and career differed from others in terms of influence or sort of resource accumulation. In our case, for the corporate sector, it's those who held multiple directorships in Australia's top companies. And we use the top 100 non-financial and top 25 financials from Simon, David and Grant's Big End of Town. And I have used as close to the same method as possible for two new lists of top firms in 2007 and 2018. So benchmarking is a very good thing. It allows us to identify separate cohorts within which all members operated concurrently and in the same context. So crosstopography is next, and this is where you can more or less lose a year of your life. The method seeks to understand the common features of a group of actors through the analysis of their collective life histories. So we looked at a combination of demographic and descriptive categories, which we've triangulated from a wide range of sources. And this speaks a little bit to what Lionel and John and Hamish were talking about earlier about linking records. So to give you a sense of the scale of data collection here, we've got 8 benchmarks, each with around 100 to 150 people, so just under 1,000 people in total, born at any point between the 1860s and the 1980s. So we've got archival sources, we've got media, we've got obituaries, annual reports, company records, personal websites, LinkedIn, and so on. It's actually easier to get data on the dead ones than the alive ones. And look, availability of sources is an issue, consistency is an issue. Some of the categories, it's much easier to get data than others. And you know what, we've done our best. And I'm happy to stand here and say that if there's more out there, I'm not sure where it is. And I think that this is a very comprehensive sample. So to start with some results, Australia's corporate elite was a relatively small but a highly influential group. Just to demonstrate, here is the 1986 network of directorships of top companies. More or less, I won't focus on the networks, that's for another paper, but this is just to say that this is a group of people that had quite a lot to do with each other. So these cohorts of, around 100 people, depending on the benchmark, held between 25 to 35% of all board seats in top firms in that year. And they connected most of these large firms within a single cluster. So you can see here for the network of individuals, so each node is an individual and each edge is a connection based on sitting on the same board. You can see here that most people in this community can reach each other within 3 or 4 moves. So it is a highly connected group. Membership of a top company board was associated with substantial connections to others, with meetings held regularly once a month or so in each of the benchmark years. So in addition to these sort of substantial webs of board memberships that structured the communication amongst the elite, members also shared remarkably similar characteristics. And look, the age profile has been really, really consistent. The average age was 60 and there was very little variance. So I think the lowest average is 58 in 1997 and the highest is 62. So it's most people were in their 50s and 60s at the time of the benchmark. And this, is a wee bit older than the median age of the Australian population at 37 years. But there's good reason for this. Age and wisdom are often associated, and older board members may have been preferable through the lifelong accumulation of skills and knowledge. So, in addition to being pretty old, the corporate elite was also pretty white. Despite almost 1,000 people across 110 years, there's been only 30 total non-white interlocutor directors in Australia. And most of these have been appointed since the 1980s, and even in the most diverse benchmark, which is 2007, 99 white members and 9 non-white members is a pretty poor record for ethnic diversity. So as a migrant and settler colonial nation, obviously corporate leadership has not represented the Australian population. What it does reflect is Australia's well-documented systemic racism, particularly within corporate structures of power and other leadership domains such as in politics. So to contrast, since the mid-2000s, Australian corporations have put in quite a lot of effort to improve the number of women in leadership. So mentorship programs, compliant explained procedures, various pipelines for women to enter into the corporate leadership sphere. As a result, there's been really good results. The proportion of women in the interlocked directors increased from 9% of the cohort in 1997 to 37% in 2018. So there have been some really welcome advances in gender diversity, mostly because of those targeted policies. So moving on to education. Look, anytime I speak about this project, people usually go, okay, I bet they all went to King's, I bet they all went to Scott's or Geelong Grammar or whatever. And you know what, they're kind of right. Depending on the benchmark, between sort of 63 to 90% of interlocked board members attended a private or Catholic school. Those in the middle decades were more likely to attend a public school, but even then it's very much the minority of cases. However, in comparison to places like the UK, where say Eton exerts quite an enormous power over the elite, in Australia, it was the general context of private school education rather than the specific school they attended. Members tended to go to their local private school, and there was this geographic decentralisation that I'll talk about in a minute, which meant that people would go to the local Perth private school rather than all going to somewhere in Sydney or whatever. So the completion of post-secondary schooling increased dramatically from a low of 32% in 1930 to over 92% of the sample in 2018. So this is partly due to just the expansion of professional work within the corporate elite more generally, and the gradual move of professional accreditation into university structures. So it just became more normal for people to have tertiary qualifications, especially if they were going to be working in the professions. Over time, as kind of the extension to that credentialisation process, postgrad education also became more widespread, with 40% of members in 2018 holding some sort of postgrad qualification, usually an MBA. The particular education profile of the elite has more or less been dictated to by the requirements of the relevant professions. So entrenched professions such as law, accountancy, banking, and engineering were really important, and there were other sort of smaller compositional changes that I won't dwell on here. So essentially, for corporations, the professions have been really necessary for their growth. They provide a mix of expertise, legitimacy, moral authority, and confidence in sort of the corporate system. So although professionals increasingly dominated the corporate elite throughout the 20th century, in the first few benchmarks, there was actually a mix of those with hereditary power, so the fancy people, entrepreneurial experience, and those sort of politicians or public service personnel. For example, in 1930, 27% of the cohort occupied board positions primarily due to their family connections. So prominent names like Bellew, Hoskins, Horden, Elder, Packer, Murdoch, Lowy, Meyer, and so on, all show up throughout the benchmarks, including not just the really famous ones, but like their descendants as well. The appeal of these hereditary appointments is very clear. Like the father wants to maintain lineage in the family company. From a board perspective, though, there's also much to recommend the continuity associated with having the same family involved over the long term. So they know the business well, they have emotional ties to the company, they're good stewards and so on. Of course, with any family firm, there's also can be conflict and misappropriation of resources and that sort of thing as well. So that more or less covers education and experience. We'll move on now to geography. So the corporate elite has reflected Australia's broad population and economic geographies. Most of Australia's population and economic activity is clustered along the southeast coast, particularly in Australia's largest cities of Melbourne and Sydney. In addition to being home to most of the people, these cities also host most of the Australian company headquarters, as well as the branches of multinationals. So given that, it's unsurprising that depending on the benchmark, we've got between about 60 to 84% of Australia's interlock directors have lived in these two cities. The balance of power between them has shifted over time. So Melbourne was home to the larger proportion of members earlier on. Each hosted roughly equal shares in 1964 and 86, and Sydney has dominated the share of directors since 1997. The elite was also composed of those who grew up in metropolitan areas. So getting beyond the Sydney-Melbourne dichotomy, people in Perth, Brisbane, and Adelaide also were important, and they were usually people who were born and lived in cities. Although rural-urban migration was consistently a part of the elite, those born in the cities was more common. Each city had their own fancy suburbs that members of the corporate elite made their home. And these were essentially shaped by historical concentrations of wealth and prestige. Sydney and Melbourne, to take that example, have very different topographies, which has been reflected in their relatively prominent suburbs. So in Melbourne, the elite has been clustered in a single large suburb in the city's inner southeast. No prizes for guessing, it's Toorak. To compare, Sydney's growth around a natural harbour meant that rather than clustering in a single wealthy suburb, members of the Sydney elite instead came from sort of smaller pockets like Potts Point, Rose Bay, Vaucluse, Point Piper, Balmain, Mossman, and so on. I live in none of those places, and I've never lived in any of those places. And so essentially what we've got here is a decentralisation of the elite. There's the importance of local communities. We've got a Sydney-based elite, a Melbourne-based elite, a Perth-based elite, and so on. So the importance of these local communities is also sort of shown through the elite's various public and semi-public social spaces. So there were four main types of clubs found within our data. So we've got general members clubs, such as the Melbourne or Australia Club, sports clubs for golf, yachts, rowing, tennis, racing, so on. Professional groups like the Institute of Chartered Accountants or the Australian Institute of Company Directors. And finally, their involvement in charities, hospital boards, and cultural institutions like museums or the Symphony Orchestra. So over time, there was, shifts in the importance of these different types of organisations. With the proportion of those listed as members of one or more of the general members clubs increasing to 80% in 1986 and then declining to about 13% in 2018. Those listed as members of sports clubs sort of fluctuated between 40 to 65%, and membership of those symbolic groups has increased more recently to about 60% in the 2000s. Reflecting the dominance of the professions for the elite, membership of professional associations has been important more recently, with I think in 2018, 80% of members being part of some form of professional association. So some of these clubs complemented company boardrooms as physical spaces where members of the elite interacted. So members clubs particularly were important places for meeting and forming connections. And Simon, David and I have discussed that for Melbourne in particular. The Australia Club and the Melbourne Club were important business spaces. However, it was much more common for clubs and associations to operate as symbols of the members' elite status. There was actually relatively little concentration in the specific clubs that they were a member of, with the directors likely to be members of their local sports club or their local members club, or the charity that reflected their interests, rather than a specific association. So this diversity meant that membership of similar types of social spaces, rather than the space itself, was important for Australia's corporate community. So that's a lot of data. Thank you for staying with me. So to wrap up, look, in addition to very substantial interactions within boardrooms, Australia's corporate elite also had very similar demographic, social, education profiles. In some cases, these biographical features created additional sort of tangible activities through which directors interacted. However, there was substitution between the various features, with differences in the actual places that elite directors might spend their time, but similarity in the types of things that they might do. So this similarity of characteristics, or as sociologists call it, homophily, reinforced the structural board interlocks in the cohesion of the group. And look, rather than the post-war decline of the corporate network, as Mizruchi has found for the US, in Australia, the corporate community is actually more cohesive than ever. Interlocking directorates are part of this story, but the Crosstopography data provides a complementary perspective, revealing that the sort of people sort of entering into those interlocking directorates have come from really similar backgrounds, and in lots of ways, those backgrounds have become increasingly similar over time. And this has implications for large firms because obviously similarity of characteristics improves trust, eases communication, but also potentially leads to groupthink, conservatism, inflexibility. And look, while diversity in decision-making is certainly on the agenda of many corporations, I think it's worth highlighting that that diversity should probably extend beyond gender to include ethnicity, age, class, professional background as well. Thank you.
Oh, oops, yep. Thanks, Claire. Any questions? Oh, yeah, Grant.
Thank you. Absolutely fascinating. Is there any instances, you talk about the elites being very geographically determined, are there any instances of an elite being across particularly, say, Sydney and Melbourne, and is that more likely in a later period, perhaps in the 80s and 90s versus the 1920s and 30s?
Yeah, that's a really good question. And I've just finished mapping company headquarters onto where they lived. And in the early benchmarks, it's really unusual for them to live in a different place to the company headquarters for obvious sort of transport logistical reasons. As we get closer into towards the end of the 20th century, as transport becomes more available, they're more willing to move, to sit on a company board. And even companies like Bell Group in the 1980s, they had their various subsidiaries had headquarters in different cities. So of course there was mobility there.
Pierre? Pierre, Pierre, I think I can't hear you. I'm not sure whether you are unmuted, but I'm trying to figure out whether you might have to unmute you again and see whether that works. Nope. Ah, okay. So, but we'll go to Lionel in the meantime, and Pierre can figure out whether he can get some sound happening.
Hi, Claire. Just a simple question. Tell us more about how you're defining ethnicity.
Yep. No, that's a good question, and I think I've got two categories: white and non-white. And it's a really slippery category, because where do you end Western Europe, for example? So we include Anglo-Celtic and Western European as part of the sort of the traditionally whiter or white category, and then everything else not non-white. Not perfect, but that's how we've done it at this point.
Yeah, because the figures were really interesting, because in 1910 you had a quite high percentage and then it drops away.
Yeah.
So yeah, I was wondering if you're including Middle East and etc. Yeah. So
in the 1910s, it's an interesting case, and I'll just speak briefly to that. I included German Austrian directors, of which there were quite a few, and because they were later persecuted, they were like put in camps and stuff during World War I. I did include them as part of like the non-white category. And again, the concept of what is white is historically constituted. It's probably going to mean a different thing in 1910 than it will later on. But that kind of explains that 1910 figure.
Could you, sorry, can I just follow up on that? Could you split that by major European country? I mean, I think like the Italians, the Greeks, that will probably be an interesting part, because to some degree, if you look at Australia's overall demographics, if you have what, I'm not sure what the current numbers today, but like it's probably over 90% or 95% white. So if the total population is 95% white, I'm not surprised that the directors are 95% white. So in the sense, saying like, it would be interesting to kind of like, yeah, if you can split that into kind of more of like backgrounds, especially because there are differentiations that could be made with like the ethnic type backgrounds of immigrants, and then kind of like people coming later on. Can you distinguish immigrants from non-immigrants, like people born in Australia versus non-born in Australia?
Yeah, and that's one of the figures I chose not to include. Okay. And that sort of speaks to some of those ethnicity questions. And we've got essentially two sections. First, there's a lot of overseas born and overseas based, sort of British based directors for those freestanding companies. And then more recently, more overseas born people, because of like, we live in a more globalized world and mobility is a little easier and that sort of thing. So that's a good suggestion. And I think your point about distinguishing based on the characteristics of the company, of the country at the time is important.
Oh, I think Anne had a question.
Yeah, Claire, I can't remember whether you mentioned this when you were talking about the memberships and the clubs and affiliations, but it seemed to me that when you got more women in there, you had less sporting clubs and less social clubs.
More? Did you say more sporting clubs?
No, you had less sporting clubs and less social clubs when you had more women on the boards.
Yeah, and that's true, and I'm not sure if there's a causation there. I think that the inclusion of women and the general sort of decline of the members clubs as a thing probably are occurring at the same time, not necessarily because women aren't interested in going to them, though. Yeah, so I think that there's as the last few benchmarks occur, those members clubs become less important, and we have women at the same time. I'm not sure if they're like pushing out of them.
Well, I'm not sure whether some of the social clubs allowed women to join them,
yeah,
and whether they still don't. And some of the sporting clubs, if you're talking about Melbourne, it'd be things like the MCC, which is very difficult to get into if you're a woman, other than as an associate. Yeah.
Yeah, no, and I think that I can't think of many women who are a part of those sporting clubs. Interestingly, some of the corporate women were part of golf clubs and things like that. Seems to be a particular type of sporting club that women were a part of as well, but probably not the AFL club or whatever.
Just on two quick questions from the chat. First, about the social clubs. Does this include peak bodies and think tanks? The second one.
Yeah.
So, and then okay. Can I just, with Pierre's question, which is again diversity, can I ask, like, how stable is your set of companies? So what I mean is saying that, like, if you have to, like, you have 100 in 1 year, and then in the next set you have 99 the same companies, then there's probably not a lot of change. On the other hand, if you have 100 and then like suddenly you lose 30 of those, and so you get like 30 new ones coming in, you might get changed just by the fact that like you have a change in composition of what firms are there. So is the change in diversity driven predominantly by companies changing, or is it driven by which companies you have that are set in this kind of like top set or sample that you include?
Yeah, that's a really good question. And Pierre, that's a good question as well about what sort of companies are appointing women or appointing non-white directors. And it's not something that I've explored, but the hypotheses are essentially what you say, Florian, that new companies or, the non-establishment companies might appoint younger directors, might appoint women and so on. The other hypothesis, of course, is that there's like a market leader effect. Like if BHP puts women on their board, then the others will probably follow. And I would say that in terms of the appointment of women, it wasn't a company thing. If they had their choice, they wouldn't have done it. It's because it's part of the UN Sustainable Development Goals. The government's threatened intervention, and so they essentially went to a self-regulating system so that the government wouldn't stick their nose in as far as women on boards, and so that now they have these guidelines and so on. But without that, I doubt it would have improved very much.
And I think Cam's question about what is included in your social clubs kind of like universe.
I don't include think tanks. I potentially there's reason to include that, but it's not in the data at this stage. It probably would fit within the professionals if so. But I also, think tanks, depending on whether they're political or not, sort of fit under the political connections, which I didn't really discuss here.
Okay.
Thanks.
Do we have any more questions? And
I just have a question, thinking at it from the perspective of the company that I work for, which was Australian Paper, which is now Japanese owned. So before it was bought by the Japanese, it had a board and it had lots of connections with other boards, etc. But now it's a company that you wouldn't consider as part of your set. How many other companies have sort of disappeared because they've been bought by foreign entities?
That's a really good question. And the data actually does consider Australian subsidiaries of multinational firms. So we have Mitsui, we have Mitsubishi, we have ING Bank, and we have those subsidiaries of multinationals if the Australian subsidiary is large enough to be considered part of the top 100. So we do have multinationals, and actually that's one of the reasons we have any non-white directors at all. It's not the Australian companies that are doing that, it's the overseas companies have their own directors on the Australian subsidiaries.
So yeah. You're saying that the picture is even worse than it looked, in that your non-white or your non-white board members have been forced by the fact that they're owned by people that are non-white.
Yeah, exactly. Yeah. So overseas companies, particularly in Asia or the Middle East. Yeah. But what is an Australian company? Simon could probably not answer that. And neither can we. Like, I would consider an Australian, if they're registered here, I consider them an Australian company. I don't know. It's a hard one. Grant.
Just to bolster the period before the 1940s in terms of going about firm size, so your focus is very much on larger firms. When we looked at IPOs of Australian companies and looked at the board composition of IPO businesses, we found a very, very similar pattern to what you have found. I think there was possibly one woman out of 251 IPOs between 1920 and 1939. I don't think there were any people of colour on those boards, and they were typically, they were very prestigious, very often, involving military politicians, peers, I would imagine, linked into the same elite that you're talking about here. So they're smaller companies, but probably the same sort of composition, leaving aside family, which was important for smaller companies.
Yeah, and that's a really interesting point about the fact that the smaller companies actually do worse. And there's a lot of literature on that, that as companies get bigger, more famous, more sort of subject to public scrutiny, they do better on some of these diversity objectives. But again, most of the policies are to do with gender, which has performed quite well, but only because it gets a lot of attention.
One question. So, student of mine, we did this for Chinese banks and looking at intellectual directorates. And we do find that, like, for quite a few, there's actually more than one director that sits on the boards of both entities. So you have like 2, 3, 4 people that are sitting, that are shared directors between two companies. Do you observe that as well? And kind of like, in what kind of circumstances you actually find that might be the case? It's just like, oh, one company owns a substantial share of the other company, and therefore we like send basically all our board over? Or is there like, well, this is the local, whatever, Touareg board, and then they're like, on the 3 companies that are sitting in this area, they're all sitting on there, kind of thing?
Yeah, great question, and that's the next paper. But I have done the data on it, and I can tell you that particularly in the 1980s, it's business groups. No one here will be surprised. So cross ownership of different of different firms meant that they would send their people to sit on the other company board. Geography is really important. So if they are headquartered in the same city, then they're probably more likely to share directors. Industry doesn't really, so same industry doesn't really matter. And so these business groups throughout history do exert quite a big impact on having not just one, but multiple shared directors. So there's those very dense connections between firms. Yeah, good question. Thanks, Florian.
I've got another question. You can tell I'm excited about what you're talking about. I wonder whether you've looked at the relationships between the politicians and the families, etc., that have produced your board members, and whether you've got the same connections through the clubs, through the family connections, all of that sort of stuff.
Yeah, so I have looked at it, and what I can say, like, it's hard to say definitively in terms of more informal connections such as family, or whether they knew each other at a club or whatever, because just because they were a member doesn't necessarily mean they have anything to do with one another. What I can tell you is that there is very few career politicians in the elite, in the corporate elite, very few, and I was surprised. And that's different to the UK or the US, and it's a distinctive feature of Australia's corporate elite, is that it's mostly professionally based rather than political elites. Yeah, so
I can understand that. I think I know of 2 engineers, but that are politicians. But I was thinking more of the school connections, the family connections, coming from the same strata of society, in effect.
I would say that they did. So the people in Touareg, for example, they're not all company directors. So some of them are going to be elite politicians, and some of them are going to be just like fancy layabouts, and some of them are going to be corporate types. And so there would be multiple avenues through which they could have interactions with one another.
Yeah, I was just thinking of your networks where you were sort of saying people are only 3 or 4 steps away from each other, and I just have a sense that that's the same thing for our political elite and business.
Yeah, absolutely.
Yeah.
Okay. Anything else? Any other questions?
Got one from Pierre.
I think that was, again, was about diversity. Yep.
Okay.
Okay.
I was just going to make one quick point.
Oh, sorry, it's another one.
Sorry, yeah. Just regarding diversity, of course, there was the White Australia policy, which existed in a number of colonies before Federation, and then obviously from 1901 up until the 1960s and 70s, which would have made it very unlikely to be much diversity or ethnic diversity on any boards. So,
yeah, I agree, Andrew. And yeah, so we're talking about a situation where not only is the country less diverse, but, and then that flows through to the people being employed and then the leadership structures or whatever. And I agree with you, but it hasn't improved very much. You know, with the dismantling of the White Australia policy, and even through post-war migration, it hasn't improved as much as you might expect it to.
Mm. Yep, good point.
Good. Okay. Yeah, so David mentions that there are some legal requirement that companies might actually have local directors. So that obviously leads to certain kind of selection issues of who might sit on a board. Anyone else? Good. Okay. Then I'll think unless anyone is going to interrupt me in a second, please feel free to do so. Otherwise, we might close this. And thank you all for attending. And then we'll start again tomorrow morning, 9 o'clock, or in David's case, a little bit earlier. But yeah, so looking forward to seeing all of you tomorrow again. Thank you.
Thank you very much.
Thank
Have a
you.
good night, everybody.
Bye.
Thanks, everyone. See you tomorrow.
Bye.